investing in property makes sense. Investing in the right property takes knowledge. Welcome to the Rewarding Property Decisions podcast. I'm Jared McCabe, Director of Wakeland Property Advisory. Join me for expert insights into the fundamentals, trends and opportunities to help you create long-term wealth through smart property decisions. Hi everyone and welcome to episode 46 of the Rewarding Property Decisions podcast. So the market's started to open up now for 2023. We've seen a couple of good weekends now of open for inspections, which is typically the case after the Australia Day long weekend. We start to see new listings and new campaigns commencing. It's certainly been a lot slower though this year compared to last. So the second weekend in February in 2022 saw in excess of 1,000 auctions that weekend, whereas this year, this coming Saturday, we'll see only just over 600 auctions. So the supply levels are certainly down, but demand is as well, which is why the market, it's certainly come back significantly, which is what we'll talk about, but it possibly hasn't come back as much as it may have if the demand levels hadn't held as well as they possibly have. So what I thought we'd do is we'll go through, we've produced our 2023 property report, which we're doing on an annual basis these days. And as is always the case, it's a fairly substantial document. So what we're going to do today is just cover off on a couple of parts that I thought would be quite interesting to discuss. Now, you should have received a copy if you are on our mailing list. You will have received that report, but if you're not, there's certainly a link to the episode within this episode, of the podcast within the information blurb, and you can visit our website and download a copy from there. So the two major areas that I wanted to cover off from the report today, the first one is that we'll give you a quick overview of 2022 and what the market's done and some of the driving factors. And then I wanted to look at what we believe will be the five major issues shaping the market for 2023. So let's have a look firstly at the year that's been for 2022, and Melburnians finally saw off the last of the COVID lockdown, but as a result there was a new spectre that started to loom, and that was the impending interest rate rises that we've all no doubt read significantly about. Now, in hindsight, looking back, the market probably peaked in Melbourne in late 2021. And things continued to really tick along at the start of 2022. The market was still looking good. As I said before, the supply and vendors still had confidence that there was going to be demand there. But many buyers, they've certainly remained confident, particularly off the back of assurances from the Reserve Bank Governor that there was unlikely to be any interest rate rises until 2024. So the market still had a degree of confidence there. But as inflation started to rise and things started to change, and we saw the first interest rate rise of 25 points in May, obviously market dynamics really started to alter. And by the end of the year, we had seen a total of 3% increase in interest rates, and the cash rate was sitting at 3.1%. So while at the start supply was reasonably strong, as the buyers pulled back because of those interest rate rises, the market changed. And so we did start to see values come back quite noticeably. Buyers were obviously very mindful of mortgage stress that could come as a result of these interest rate rises. Those that potentially had fixed interest rate loans that they'd secured a number of years earlier were worried what the change in their interest rate would be once those loans came to a conclusion. And obviously, depending upon when you purchased, there was the potential for negative equity. So there was a lot of things playing on buyers' minds that meant that they did start to pull back, or in some circumstances, which we certainly saw with some of our clients, they still wanted to pursue purchasing a property, particularly owner-occupiers. But in a lot of areas, they were pulling back their limits to take into account the rises that were continuing to come. So what this resulted in was that Melbourne prices fell 8.1%. The median price fell that much for the year, which was the largest calendar year decline since CoreLogic records began in the mid-1980s. So it was certainly a significant reduction in values. Now, let's have a look going forward at 2023 and what the five major issues we believe will shape the property market in Melbourne for this coming year. First one, obviously, being further interest rate movements, which will impact on the property market. Now, clearly, interest rates have been the driving factor of performance in the last year, and that's not likely to change in the year ahead. There's been mixed expectations from different economists and different people predicting on what interest rate movements might look like for the coming year. There's certainly been some saying that there'll be limited rises, perhaps only one or two. In more recent times, there's been some predictions saying that there could be 4 or more interest rate rises in the year ahead. And others are saying that there'll be some interest rate rises in the first half of the year, followed by reductions in the second half of the year if the right circumstances prevail. Now, obviously, that's the Reserve Bank's decision, and they'll certainly take their cues from things like employment levels, investment spend, consumer and business confidence levels, and obviously what inflation does do over that period of time. Now, unfortunately, we don't have a crystal ball. It would be fantastic to have one. But what we can do is look at past patterns of how interest rates and property markets have related to one another and how things have changed as a result of interest rates moving. So it's interesting to note that the interest rates can fluctuate markedly, while the property market does certainly have its ups and downs. But if you look at the long-term trend, and there is a really good graph in the property report, it shows that there is still that the trajectory line for the property markets is certainly still always on the up for Melbourne. And the expectation when it comes to the relationship between interest rates and the median house price movement is usually that if you see a reduction in interest rates, the intention is to spur the property market on, and you'll see increases in value, while increases in interest rates would normally hold enthusiasm and prices would start to reduce. Now, this graph shows that over the last 10 years, that's generally been the case. However, it's not always what happens. So if you go back to 2002 through to 2008, interest rates were steadily increasing over that period of time, but the property prices were as well. Now, that came about off a significant period of time of pent-up demand through the first 8 or 9 years of the 1990s, where the property market was stagnant that entire time. So that pent-up demand really drove market activity from the late 90s through to about the GFC in 2008, when obviously circumstances changed again. But it certainly meant that there was, even though interest rates were on the incline, the property market certainly was able to withstand that and continue to increase. The second point for the year ahead is that the sales market is likely to continue to ease, but the rental market is continuing to soar, and that's likely to be the same going forward. Obviously, during the pandemic, the rental market in Melbourne suffered greatly as a result of the border closures. There was no overseas travellers coming in. University students, both domestic and international, were not taking up rental properties. Expats were not returning from overseas, and we weren't getting the migrant numbers that we would traditionally get into Melbourne. And so these groups that typically, they do make up a large portion of renters in Melbourne, and that had a significant impact on rental values over that period of time. And it was then compounded further by the exodus of Melburnians going regionally or perhaps even interstate, and that took even further tenant demand out of the market. But if we fast forward to 2023, and the majority of us are fully vaccinated, borders are now open. We're seeing immigration really start to rise, and that's expected to continue this year. And we're not likely to see any more lockdowns, hopefully anyway. And as a result, the rental market is really now starting to resurge, and that's a really good thing. It's certainly very good news for investors, but it is making it tough for renters at the moment. The city saw its greatest decline in new listings, which was down 16% year on year this year. And the vacancy rate is also at historic lows. So that's really creating pressure and pushing rental figures up, which, as I said, is good for investors, but it does make it tough for the rental market at the moment. And it's likely to continue with these strong levels due to continued tougher buying conditions. You're not likely to see current tenants being able to perhaps step into the market because it is so tough with interest rates the way they are at the moment. And this will mean that there'll be less, obviously, investor demand until we start to see that shift that we were talking about, where to help it with increasing supply levels to take the pressure off the demand. So that's what we really need to see, and that's not likely to change anytime soon. So I think the rental market is likely to continue to be very strong through this year. The third point is population growth, which will continue to fuel capital growth going forward. Population in Melbourne is certainly resurgent. It's set to continue to fuel strong demand for houses, which will underpin that long-term capital growth. It may not have an impact in the short term, but long-term we certainly feel it will continue to drive strong capital growth levels in Melbourne for property. COVID certainly pushed Melbourne's population levels into decline, but now that we are back on track and set to still overtake Sydney's population just after 2030, which is a little later than expectations were, but it is still on the horizon. So that growth will continue to be driven by international arrivals, but it's also by other Australians from around the country looking to move to Melbourne due to the lifestyle attributes that we do offer. And we'll also see a bit of a reversing trend, which is the reversing COVID trend, which is good. Sydney-siders are certainly attracted to Melbourne at different points because property prices are relatively affordable. We've obviously had some really good growth during the pandemic. However, Sydney's was next level. So it's certainly achieved some very strong growth levels as well. And so Melbourne is still seen as relatively attractive from a property price point of view. The other thing that's likely to continue is a regional market reversal, and that's really starting to take hold. The further demand for Melbourne property will come more so from that regional market. And the COVID regional boom that we certainly saw is starting to change and starting to recede as many start to tire of the regional lifestyle. It's not for everyone. And they might, and particularly people that have grown up and really enjoyed metropolitan living, might be starting to understand or realise that the lifestyle perhaps isn't for them. It doesn't necessarily offer the services that they may have expected, and infrastructure benefits are not the same as what they are in a metropolitan area. And nationally, we're seeing this is not just in Victoria and in Melbourne, in that regional markets that grew so strongly during the pandemic, according to CoreLogic, are some of the fastest in terms of reductions in values. So if we focus more on Victoria, the greatest decline in values has been in Druin in West Gippsland, which has come back 10.8%, East Geelong 10.2%, and Belmont 8.8%. So there's some of the regional areas that have shown the greatest reduction in value. And we'd expect that to continue and see more reversals where regional occupants will come back to Melbourne and probably taking up in some of the middle to outer ring suburbs. The final point that we think will have an impact on the property market for Melbourne in 2023 is the likely change in investor activity as it begins to become something that investors are considering. While we see rents continuing to strongly grow, we'll see the population in Melbourne continue to increase, and we'll see renewed appreciation for city living, as well as softer competition and easing of prices. These are factors that are really likely to start to pique the interest of investors and make them start to consider whether now might be a time to get back into the property market. It's likely to occur more so once investors believe that we've reached the bottom of the cycle, and there is still likely to be some further reductions in values this year. So it's not likely to see a significant change in values, but as conditions start to alter, they are moving in favour of investors. So as I said, it will start to pique their interest. It's been subdued for a significant period of time. And particularly, even though we have seen good growth during the pandemic, that was really driven by owner-occupiers as opposed to investors, primarily because that time coincided with high vacancy rates and low rents, which are not conducive to investors. They still, even though capital growth should be the key driver and key focus, rental returns are still very important. And that was emphasised by the fact that since the first rate rise in May last year, lending for investments fell 24% according to CoreLogic. So that really does indicate that the price of debt is still having a significant effect and is still impacting whether investors will enter the market or not. So as we do begin 2023, I think they'll still remain cautious, but it's starting to turn. And so once we do see interest rates stabilise and prices start to plateau off, these two key factors will start to mean that investors will consider that it might be time to get back into the market. And if you combine those with resurgent rental figures that we've been discussing, the sharpening vacancy rate, which continues to do that, and increased immigration and population growth, all these factors will really start to bring about the options for investors to get back into the market. That's about it for the 5 points that we wanted to discuss today. As I mentioned earlier, the property report is very detailed, so we've only covered off on select parts today. And if you aren't on our mailing list and would like to get a copy, please visit our website and sign up to our mailing list, or contact the office and we'll gladly send you a copy out. So thanks again for joining me for episode 46 of the Rewarding Property Decisions podcast. As always, please share the podcast far and wide and recommend it to any friends and family that may find it beneficial. If you would like further information on making rewarding property decisions, please visit our website, wakeland.com.au, and we wish you all the best with your property decisions.